All right, let's talk Dollar General. They just dropped a Q2 earnings report that really made Wall Street sit up and pay attention, and honestly, for good reason. For a while now, they've been playing defense, just trying to get their house in order. But this quarter? Well, this quarter signals they're ready to get back on offense. So let's break down what's really going on here.
So let's start with the headline number that got everyone talking, $1.86. That was their official GAAP earnings per share. Now, on its own, a number's just a number, right? But the reason this one mattered so much was how it stacked up against what everyone was expecting. And when you look at the scoreboard, you can see why it was such a big deal. That $1.86 wasn't just a small beat, it was an 18% beat over what analysts had penciled in. That's huge. Revenue also came in strong, and same-store sales were up a healthy 2.8%. And that growth came from both more people walking in the door and from those people buying more stuff. The big takeaway here is that this wasn't just some accounting fluke. It was a sign of real fundamental strength. And you know what? The market noticed, big time. The stock jumped, and it jumped on heavy volume. We're talking about 2.3 times the average. When you see a move like that, it means there's real conviction behind it. This wasn't just a good quarter, it felt like a statement that their turnaround plan is actually working. And this is the line that really sums it all up. This phrase, a pivot from defense to controlled offense, captures the whole theme of the earnings call. For months, it's been all about defense, fixing nagging internal problems. But now, with a much stronger foundation, they're starting to push forward again, but in a really smart, strategic way.
So how do they actually pull this off? Let's get into the nitty-gritty, behind the numbers, because this is where the real story is. And you know what the single biggest factor was? A little thing called shrink.
Now, for anyone who's not in the retail world, shrink is just the industry's term for lost or stolen inventory. It's a massive, massive headache and a huge drag on profits for any retailer. Getting a handle on it has been priority number one for Dollar General.
And their success really boils down to this number, 108 basis points. Now, that might sound like a bit of jargon, but what it means is that by getting shrink under control, they added over a full percentage point, 1.08%, directly back to their gross margin. That was the single biggest reason for their earnings beat. And it's just crystal clear proof that their back-to-basics strategy is paying off. But it wasn't just about shrink, not by a long shot. They're getting smarter everywhere you look. I mean, inventories are down more than 5% from last year, even while sales were going up. That's tough to do. Store manager turnover is down, which is absolutely crucial for stability. And all of this is fueling really strong cash flow, up almost 10% so far this year. This is what a healthier, more efficient business looks like. Okay, so that's the defense, right? They've plugged the holes in the boat. Now for the fun part, the offense. How is Dollar General planning to actually grow from here? Well, it really comes down to two big things, their physical stores and their push into digital. First up, let's talk real estate. And let me tell you, they are not hitting the brakes. The plan for this year alone involves nearly 5,000 different projects. Yeah, that includes opening about 575 new stores in the US, but the bigger story is the huge investment they're pouring into remodeling their existing stores. And they're running this kind of two-pronged attack. You've got Project Renovate, which is the full-blown traditional remodel that they expect to deliver a 6 to 8% sales lift. Then there's Project Elevate, which is a lighter touch, more focused on merchandising, and that's targeting a 3 to 5% lift. When you add it all up, they're upgrading over 4,200 stores this year alone. That's how you drive growth from your existing base. But the real game changer, in my opinion, is on the digital side. I mean, they are going all in on delivery. Their DoorDash partnership now covers a massive 17,000 stores, and they just rolled out a new deal with Uber Eats, aiming for 14,000 stores by the end of the third quarter. This is all about making themselves the most convenient option, bar none. And here's where it gets really interesting. This is a quote from the CEO, Todd Vassos. 1 hour delivery. Think about that. For the 80% of their stores that are in small towns and rural areas, this is an incredible competitive advantage. Who else can do that? It's something that even giants like Walmart and Amazon would find really, really hard to do efficiently out there. Okay, so the story so far sounds pretty rosy, right? But management was smart. They didn't just pop the champagne and take a victory lap. They were also very realistic about the potential bumps in the road ahead. So let's look at their guidance and the risks they're watching. First, let's look at the confidence. They felt good enough about the first half of the year to raise their guidance for the entire year, right across the board.
They're now calling for higher net sales growth, higher comp sales, and a pretty significant boost to earnings per share, taking the top end of the range from $5.80 all the way up to $6.30.
But with that confidence came a healthy dose of caution. So what are the potential headwinds that could throw a wrench in this really positive story?
Well, management was pretty upfront about it. They said they're bracing for increasing pressure on consumer spending in the back half of the year, and they specifically called out the fourth quarter as a potential trouble spot. On top of that, there's a CFO transition in the works. And of course, there's always the big unknown, the potential impact of tariffs on their prices and margins.
All right, so we've got the good, we've got the cautious. How do we put it all together? Let's boil it down. Here's our take on where things are headed and what we're watching for on the next call. Our core thesis here, the big idea, is something we're calling digital alpha. And what we mean by that is simple. We believe the market is still seriously underappreciating the long-term value of Dollar General's digital and delivery strategy, especially that one-hour rural delivery advantage we talked about. That's a real moat. And this thesis leads us to a pretty specific trade idea, a pair trade. We think it makes sense to be long Dollar General while at the same time being short its competitor, Dollar Tree. The thinking is that DG's speed and density in rural America is a powerful weapon that Dollar Tree is just not equipped to copy. The catalyst? It's going to be that moment when the rest of Wall Street wakes up and starts to recalculate just how big Dollar General's market can be, thanks to digital.
So to sum it all up, yes, there are some headwinds to watch, but the operational turnaround is absolutely real, and their offensive strategy in digital is powerful and, we think, undervalued. For those reasons, our rating on Dollar General is outperform. And as always, remember, this analysis is for informational purposes only. This is not financial advice.